BRUUSH is an electric toothbrush that will change the way you think about brushing your teeth, guys. With powerful sonic technology and ultra gentle bristles, the BRUUSH redefines what it means to have super clean teeth. It's like that feeling, you know that feeling when you leave the dentist, it's that fresh, like your whole mouth is clean. Oh, it's such an amazing feeling, but it's every single day. Now, our listeners can get 15% off their total purchase with the code POD15. That's POD 15. Just follow the link in the show notes, and I'll also have it linked on our website, and you can use the code POD15 to get your exclusive discount and upgrade your oral care routine today. Well, welcome back to another episode of the Financially Free Journey podcast, and I'm your host, Courtney Geier. And today I am welcoming a guest that I'm jealous of, because Eric is located in Florida. As you guys know, I'm in Utah, and it's still cold, it's still windy and rainy, and he's enjoying the sun. I'm looking at him right now, guys. He's got a great tan. It's not fair. So without further ado, I'd love to welcome Eric Geier. And guys, his background is really in insurance and the financial industry. But Eric, I want to make sure that we do you justice. Give the listeners a brief background on what you do and how you can help them.
So first of all, I've never had so many people dislike me for living in Florida. And typically this winter alone, I've got shots taken at me from every angle.
I know, it's that glowing, dewy skin, Eric. It's put me over the edge. Okay, because I can't go outside yet. It's too cold.
So I'm originally from New York. I spent my career in Manhattan on Wall Street, covering asset managers and pension funds, helping them invest their equity assets worldwide. And I did that for over 2 decades. And I just wanted something new. Manhattan has been my residence for the 30 years of my adult life, and I just needed a change. And, I've always been somebody who looked for inefficiencies out there to make more efficient. And I started out with health coverage to the small business community, which is a huge problem. You probably know it yourself.
Absolutely.
It's expensive. The options are horrible. I found a niche in there. It's been great. While on that journey, my clients started asking me about life insurance, and specifically about the retirement side of life insurance. It just has so many benefits, and they were wholly unprepared. And so many people in this country are wholly unprepared.
Yeah,
right? What's worse than living to 90 years old and running out of money, and you're at a point where you really can't generate an income anymore at that age? So,
right. It's a major fear for a lot of people.
Yes. Yep. Yeah. And if you are married, statistics say that you have a 50% chance of living to age 90 and a 5% chance of living to age 100. So you really need to plan as if you're going to live to age 100.
What, to think the life expectancy to be able to, you have to plan till age 100. I would say not that long ago, most people are thinking mid 70s, maybe your early 80s if you're lucky. But with the advances in healthcare, it's a double-edged sword, right? Because we have those advances, but also we have to now plan for an additional, sometimes 20 years that you necessarily didn't have to plan or save for prior. So with these inefficiencies that you saw, and you said specifically within the small business realm, that is a huge area that is a major concern, right? Because a lot of small businesses and employers, they can't necessarily afford, it seems like, to be able to give premium healthcare coverage or insurance options to their employees. So what did you see in that realm specifically? What drew you to that?
People are spending $1,500, $2,000 a month for insurance, buying off of the exchange. We call it now the Unaffordable Care Act. And
right.
and there had to be a better way to do it. And, they used to call me MacGyver. That was kind of like my nickname, because I like to kind of, explore and find things where things aren't. So, it was a great option. And, if if small business owners need anything, they need liquidity, right? Because you need liquidity to grow your business, and you don't want health coverage to be a burden that you're carrying around. It's supposed to be there for to make you feel at ease, not to stress you out more. So that's where it started. I'm happy to report that my clients are very happy with that. And as we move through different stages of helping them throughout their life, it's just been an absolute pleasure doing this. I feel like I'm actually making a huge impact, as opposed to when I was on Wall Street, where you don't really see the impact on the individual consumer.
So how did your experience on Wall Street, how did that help you transition into this industry and what you're doing?
What happens is I was on the wholesale side of the business, which means asset management, traders, those kinds of things. And there was a lot of kind of nefarious things going on. Of course, you've heard of Madoff, right? He just passed away this week. And there was a lot of stuff there that really made me annoyed. So I said to myself, what if you have somebody who's got experience on the inside to navigate to the individual on the outside, so he or she can understand what their best options are, so they're not getting screwed over on things like, health coverage, retirement, stuff like that.
Oh, I love that. Again, because it is such a complex topic when you think about Wall Street investing, especially on the wholesale side, when you see really how things can be taken advantage of, right? Yeah. Specifically, the individual investor or person being insured, they're not getting the best prices available because they may not understand how the system works exactly. And so for you to have that inside knowledge, right, and experience, and then to be able to take it directly to the consumer probably really propelled your ability to be empathetic and authentically connect with them and bring them options that was actually going to benefit them.
Yeah, whenever you hear that phrase, commission free, run the other way, because
there's no such thing.
There's no such thing. There's no such thing.
Yep. Commission free means that there's going to be asset management fee. I mean, yeah. The thing is that no one's in the business to be a nonprofit. They're in it to make money, and so if they advertise it as such, that they're not necessarily being very truthful. So it's that transparency is huge. And so yes. I'm sure that's something that you've probably taken into your business, is the transparency of what they're doing, what they're getting when they work with you. Talk to us about your company. It's PureSurance, right?
PureSurance, yeah.
Yeah. So tell us the aspect. We talked about the small business portion, but what all do you help your clients with? Talk to us about that.
So I give a lot of advice around what they're going to need through their stages of life. Health insurance obviously has a lot to do with that, but people don't realize that you have to prepare for things like long-term care, right?
So expensive.
Yeah, and look, everybody needs fire insurance for their house, right? Your odds of having a house fire are 1 in 1,200. Everyone needs auto insurance, yet your odds of getting into an accident are 1 in 240. Your odds of needing long-term care insurance at some point in your life are 50%, right? Because we're all
insane.
But nobody requires you to have long-term care insurance, right?
Because again, there's nobody on the other end saying, well, we have collateral that we need to insure as a bank or a lender, so we're going to force you to insure it, even though statistically, the odds of having to tap into that insurance is not as high. So for you to be able to tap into your long care insurance is really you protecting yourself. Like, you're the bank, you're the lender that you need to protect.
Exactly right. You just hit the nail on the head when you said you're the bank. And that's what life insurance can do for you, is you have this bucket of money that you've built up through the years, and you can, on a tax-free basis, use some of it for long-term care if you need it, right? So if you just buy long-term care insurance, it's like a use it or lose it thing. But
Right.
if you have this cash value built up in a life insurance policy, you can take a tax-free distribution on that to pay for that long-term care. If we're looking at cost, the average cost of a nursing home right now, on annual cost of nursing home, is $90,000 a year. In 10 years, it's going to be $121,000.
Yeah,
So,
with the rate of inflation, it's
Yep.
definitely going to go up. That's
Yep.
for sure.
Yep. So, you just really need to prepare for those kind of eventualities. It's no fun being broke when you're older.
Well, and you don't have that earning potential, as you mentioned. And something that I really want to point out to the listeners as well is we all hope, for example, if you have children or loved ones, you would hope that they might want to take care of you, right? But you can't predict the future, the people that they'll marry or they'll be, in relationships with, what their financial situation or living situation will be. And we cannot depend and put that burden on our loved ones that they must take care of us because we lacked preparation, right, in the forefront. And so by tweaking your financial preparation and your ability to really be financially whole and not just plan for, your investments and your pension plan and, all that, it's really, insurance is a huge component because you need to be able to protect yourself. You're an asset. And one thing, if you want to clarify real quick too, because a lot of people may not be familiar with what long-term care insurance is. We mentioned nursing homes, but is there any other aspects of that long-term care that people need to realize is a part of this umbrella that we're talking about?
Most people want to stay at home. Right?
Yeah.
Most people want a caretaker at home. Do you want to go into a nursing home, or do you want to stay at home and have people come and take care of you there? Right? Wouldn't that be amazing if this house that you've grown to love so much, you didn't have to leave it and you can get care in there? That's what this takes care of.
Absolutely. And yeah, because a lot of people say, I don't want to go there. I don't want to be fed Jell-O 3 times a day or, whatever.
Right.
And
that's right.
That's a great point because, again, you have flexibility in your long-term care plan where you're in control. You're not at this point in your life where you are more vulnerable to be taken advantage of. You're more vulnerable to elder abuse, unfortunately. And so having a really strong financial plan that's been communicated to your loved ones or your power of attorney later in life, this is really critical to put in place now. And again, you've probably seen this in your industry a ton, but the burden that it puts on your loved ones to have to make that decision for you is immense. And if you love them and you care about them, you will take that off their plate and you will plan it out in advance.
Yeah, there's a lot of guilt that goes around with that. You actually said a magic word before. I don't know if you realized it. You said the word tweak. And a lot of the preparation for your future finances is come through tweaking your current investments. It may not cost you anything out of pocket. What we go for is efficiency in your investments to prepare for the future. So, we can talk all about that, as we get later into the podcast, but there are so many things that you can do right now that won't cost you another cent that can make a huge difference in your life.
Absolutely. Again, Rome wasn't built in a day or whatever the saying is. It Rome? I don't know. Some, major, huge thing. They're not built in a day. It's small tweaks. It's step by step, and it's small, smart decisions along the way that builds an empire. And so that's one thing that can be a major misconception. It's like, I am so far off from being able to afford, whole life insurance or long-term care insurance. And the truth is that you have to make those tweaks along the way, because before you know it, you're underinsured and you're in a situation where you really wish that you had done that preparation. And so it's really important to not underestimate where you're at in the process and say, well, I'm not old. I'm not at the point. No, you're not. And that's why you do it now, because the cost changes over time, depending on your health and all that stuff. So depending on the way that you go about being able to create this vehicle in retirement, which there's so many different ways to be able to create asset or cash flow for yourself. And so let's talk about that a little bit too, is you talked about earlier being able to use insurance as a vehicle for retirement. What does that mean exactly? Because most people think of insurance like I get in a car accident and then I call my insurance and then they give me money. So how does it build up cash value? Go into that a little bit.
Yeah, sure. So, and I just want to start by saying that it's not anybody's fault that they haven't heard about this stuff. And a lot of that has to do with people like Susie Orman and Dave Ramsey talking about buy term insurance and invest the rest.
Right.
So what you don't hear about is everybody over 80 who make over $84,000 a year, and that's not a person, that's a household. If your adjusted gross income is $84,000 or more, you account for 86% of all the taxpayer revenue in this country, right? Wow. You've got a tax problem. They're talking to the 75% who make under that, right? Who are you going to sell books to, right? You're going to sell books to 75% of the population or 25% of the population.
Exactly.
Right.
Yep.
So that's why you really don't hear about it. But where we are now in a tax situation, people are just taught to just put as much money as they can, max out their 401ks, right? You're going to have to pay tax on that at some point. And we're at historically low tax rates now. 37% is the top tier bracket right now. We have $28 trillion in government debt that's going to have to be paid back at some point, right?
Right.
And where are they going to take it from? They're going to take it from the 401ks because the amount of money in 401ks are astronomical. So when you think about what your future tax rate is going to be, you have to make a decision. If it's going up, does it make more sense to pay taxes now and invest everything else on a tax-free basis? Or do I want to take that risk in retirement once I built up, $1 million in my 401k? What if I have to pay 40% of that in taxes? Now I only have $600,000, right?
And now at a point in life where you don't have the ability to make up that income and that asset because your ability to work has diminished. And so again, I just wanted to point that out, that the government's going to make you pay it now or pay it later. It just, you have to adequately prepare for what tax bracket will you be in and what other cash flow avenues do you have to be able to make up for that difference. Just because you have $1 million in your 401k does not mean you will have access to $1 million in retirement if you did all of it through traditional contributions. And so I just wanted to make sure to really reiterate that because it's a really important point.
Right. And when you're retired, you're going to lose your biggest deductions, right? Because you've likely paid for your house, right? So you're not going to have the mortgage interest deduction. Your dependents have likely moved out, or so you hope, right? So you don't have you don't have the dependent care deduction. So you're going to have to pay all these taxes without having any offsets on them. So it just really makes sense to, if you can, to pay those taxes now, so you don't have to worry about things like what is my tax rate going to be, and other stuff like market volatility, right? That's another huge concern that we take off the table for people.
Yeah,
right? Because
market volatility, inflation, tax rate, is all things all these things diminish the total asset that you've worked so hard to change. And if you're not having that planning beforehand, then you're going to be in trouble.
Yes. Yeah. So one thing I can tell you is that the happiest people in retirement are those who get a paycheck.
Yeah.
Right.
Yeah. And I would say so.
And those who have resources to fill in the gaps for any extra stuff. No more pensions, right? No more pensions. Right. They don't exist anymore.
What is it, like 2% of the population? I mean, it's something ridiculously small, has access to a pension. And if you do, that is amazing. We are so jealous. But most people do not have that. You have to save for your own retirement.
Yep. And Social Security will not be enough, most likely. And who knows what its Social Security is going to look like.
Right.
Yeah. So those are the kinds of things that I just talk to my clients about, just to make sure they're educated and to fill in the gaps and prepare for, life at 100,
Oh,
for
absolutely.
example. And
Yeah.
look, you don't need to be a millionaire to establish a life insurance policy to build cash value. You could reposition as little as $500 a month to, create something that's going to be a real meaningful asset later in life.
Yeah, absolutely. Again, it's another misconception. It goes along, it's hand in hand with the misconception around investing. Like, well, I don't make six figures, so I'm not wealthy enough to invest, right? Or I don't have enough money to buy it. I'm just trying to put food on the table. The thing is that what we make a priority, we are able to afford. And so if you're able to adequately prepare, make your future a priority, your expenses and your living costs will adjust accordingly. It's just like every time you get a raise, right? You get like a 3% raise every year. All of a sudden, you need that additional 3% of income. Like every penny goes towards a bill. And somehow you're able to make ends meet prior to that. We increase our living standards and it's the keeping up with the Joneses to meet the income that we receive. So if you take it out of the picture and you plan for the future, more times than not, you can make it work,
As you all know by now, I am super passionate about education in our country, as well as your ability to increase your earning potential, which is why I'm so excited to tell you about this episode's sponsor. It's called Teachers of Tomorrow. So listen to this. The nation's leading alternative teacher certification provider, the most comprehensive provider of teacher services in the United States. Their mission is simple. It's to develop confident educators who believe in the potential of every student and has helped more than 70,000 teachers reach the classroom. They have created a new way to become a teacher. And for the first time ever, you can become a certified teacher 100% online. So this means, number one, you don't have to go back to college, no student loans. You're not putting your life on hold because you have to work full time while you're trying to study. I mean, that's really hard to balance. The best part is this, guys. You can start teaching and earning a full-time salary in months, not years. Their state-approved program is designed with one goal in mind, which is to help you achieve your dream of teaching quickly, affordably, and simply. Teachers of Tomorrow has partnered with the podcast and is offering you a free application and a discounted enrollment fee of $295, which is $100 instant savings. This is the only fee that you pay, by the way, until you're hired full-time, earning full pay and benefits. So to claim this offer, just simply click the link in the show notes and episode description. So before you go make a huge purchase like buying a car, it's pretty important to make sure you're getting the best price possible, right? Well, today's sponsor has solved this problem so you can have that peace of mind knowing that you're getting the best deal possible when making a car purchase. FindTheBestCarPrice.com is a free car buying advice website, and it helps make it easier for buyers to navigate this traditionally unpleasant and complex car buying process. Each month, FindTheBestCarPrice.com compiles and publishes the latest manufacturer incentives and offers across all brands and shares their top picks in different categories. Now, when you go to their website, make sure you look for their early access email list to be one of the first to find out all of these new deals when they're published each month. Advertised incentives are only a starting point to getting the best deal. The only way to truly get the lowest possible price on a new car is to get prices from more than one dealer. They also have a free service that connects you with local dealers to get discount prices, and so you can get their contact information to start negotiating over email. They even offer free email templates so you can copy and paste exactly what to say to car dealers so you can get that best possible deal. So make sure that you have done your research, you're getting the best deal possible, and visit findthebestcarprice.com prior to making your next car purchase.
Something as simple as not spending $4 a day at Starbucks, which could lead to an extra $90,000 in 30 years.
That's an insane. So for all my Starbucks lovers out there, right? $4 a day, that could lead to over $90,000 in what time frame?
30 years.
Like,
Think
I mean,
about
I'm
that.
just saying we could YouTube how to make a really good latte at home.
Right.
You know, we can get that matcha powder and
Which
we
is
can
what
do it
I
at
do.
home. Yeah. Just get the Starbucks cup, you know, and the reusable. Like, I think, again, you're not going to build wealth through like just cutting your coffee, right? Like we hear that all the time, but it's just a really good example. If you're giving yourself the excuse of, well, I can't afford it, you got to strip back the layers of what you're spending, what your true expenses are, and then really look at your priorities. Because if you've outlined your financial goals, then you will be able to find a way to make it a priority. And that's something I really want to hit home is, why should they make this a priority? You know, and I think we've talked about that. It's just, you know, your future and living an additional 20 to 30 years than, you know, our previous generations and our parents expected. It's a critical issue that's not being talked about enough.
Yeah, and I do webinars every Thursday night, and I show people how just minor tweaks based on the client experiences in the past can make an absolutely huge difference in your lives, and just how to escape that trap of taxation as you get older and segue into retirement.
Absolutely. Well, one thing I wanted to touch back on, you had mentioned earlier, because we talked about the current debt of our country and we're in the trillions, right? We just printed more money in the last couple of months than our country has ever printed in its entire history of existence. And I don't think that a lot of people understand what the repercussions of that will be in the future. You know, a lot of people are talking not just about inflation, but hyperinflation. You know, our interest rates are, you know, there's a pressure for them to stay downward. And with this current economic environment that we're in, this is even more of a critical time to have this conversation with a financial professional and to be able to look at your situation, because it has to be paid back. I mean, I was just reading the other day, and you probably know this too, Eric, but the Treasury is looking at creating 50 to 100-year bonds to be able to try and repay a portion of this debt. Bonds are usually, you know, distributed through the Treasury 10, 15-year time frame. So what does that mean? Our children and our children's children are going to be repaying this debt for the rest of their life. And so, you know, I wanted to know your thoughts on that as well, as far as our current economic situation that we're in and how that has a direct impact and correlation to what we're talking about.
Well, you're absolutely right that we can't continue on this path. We keep printing money. At some point, our currency is going to be devalued. Our credit rating is going to go down, and we're going to be spending a huge portion of our revenues. When I say our, the United States revenues, just in interest, debt service. You know, and you know that for sure is going to result in higher taxes for the individual to be able to do that. And it's just a really bad scenario because the economy does not work as good in a high tax environment as it does in a low tax environment.
Absolutely. It's not as efficient. And I want to give like an analogy to the listeners too. It's our country, it's like making the minimum payments on your credit card, and it just goes directly to interest. And it's like, why does the balance never go down? Because we're never tapping into paying the principal of the debt. That's the exact situation that our country is going to be in, right? Because the amount of debt that we've taken on, the debt service is so large that the majority of the taxes and things are going to go just to interest alone. And so that's something that I know I've heard this a lot from people that ask questions is, well, why can't our country just print more money? I mean, it doesn't make why can't they just print more? And that concept, I think, is not well known enough as to how it correlates, right, to our overall economy and the value of our currency.
Currency devaluation is a really, really bad problem. Remember when the Zimbabwe had was it Zimbabwe that had $1 million note because their currency was absolutely worth nothing? I mean, the United States currency will never be worth nothing. That is the extreme, but that's kind of the extreme of currency devaluation.
It's like, you know, Venezuela, for example, when, you know, how much thousands of dollars did it cost to purchase not dollars, but of their currency to purchase like a gallon of milk, right? I mean, just because you print more doesn't mean that the value stays the same. There's a downward pressure on the value because there's more in circulation. And that's why our treasury will put more in and they'll take more out. It's a balancing act to make sure that the value stays current and where it needs to be able to do business with other countries and for our imports and our exports. So it's something that a lot of people don't think about, right? It's like right now it is the stimulus, it's happened and a lot of people have received money, but now we need to think about, okay, it's happened. Now, what are the effects of it and how is it going to affect me personally and how can I plan for it? And I think that's where your company comes in hand and comes to play. And so, what are some of the biggest mistakes? This is something I wanted to touch on with you. What are some of the biggest mistakes that you see people that you work with that they've made with their money that you'd like people to be aware of?
So one of the biggest things is that they contribute more than a company match to their 401k.
Interesting.
You should only contribute up to your company match because you're not getting maximum benefit by going above that. So instead of doing that, and you made some great points proving that taxes are going to go up in the future. Take that rest of that money, repackage it, pay the taxes now on it, and put it into a more efficient vehicle. Another thing people do is people want to accelerate the payment of their home. Right? If you have a very low interest rate, a very low mortgage that you're paying, taking into consideration the mortgage deduction you're also getting, it might not make sense to put extra money towards your mortgage, right? If you have a 3 to 4% mortgage, keep that the way it is. Use that extra money that you would pay for principal and put it into a more efficient means. Mutual funds. I hate mutual funds. Why? Because you're paying tax on the appreciation every year, even though you're not recognizing any of that money. Recognizing meaning taking out any of that money.
Right.
So there's just so many better things that you can do that just require tweaking. It doesn't really require you going in your pockets at all, and it can make all the difference.
So you basically just described the whole entire Ramsey program and that you're not a fan. It sounds like,
if you have a cash flow problem, that's what you want to do. And if you're making under $84,000 a year, you've got a cash flow problem. So nothing against Dave Ramsey, but anything above that, any household income above 84,000, you've tax flow problem. And that's where your thinking needs to kind of pivot to.
It's not a one size fits all. And again, when you say that $84,000 mark, taxes change for you and your finances do become more complex. And as you said, that's a household income. So that could be, 2 people working together or one high income earner. And that's a lot of people. So that's something to think about. A lot of people are debt adverse and debt just gives them anxiety, right? But if that's the case for you, that's a personal decision, but it may not be the smartest financial decision because again, with the way that interest rates are right now, you can refinance a mortgage and you can be close to or under 3%. And if you can't make that in an investment, you're not doing it right. And so again, it's not a one size fits all, but that's the problem with a lot of the financial education culture today. It's like eliminate all debt, pay off the house, do not use credit card, right? And it's not necessarily true for every person.
That's true. And we have to kind of keep in mind when these 401ks were launched, right? They were launched in the late 70s when the top tax rate was 70%. So in the future, you can make a case for taxes are going to be a lot less in the future. And it was sound advice back then.
Yeah.
But it's flipped over on its side, and the exact opposite is true right now. So you're doing the same thing you did back then for a time where it doesn't make any sense to do that now.
Right. The reasoning, it does not correlate with the situation for most people today. So tax rates are very different. Yeah. So, okay, let's talk about your insurance products and what you do specifically. I mean, we talked about insurance products for vehicles for retirement. They build up cash value. And how is that done exactly? If you'll explain that to the listeners.
Yeah. So what we do is when we start a policy, we do the least death penalty that's allowed by law. So that makes the policy very affordable. And the government actually knows how much of a benefit this is. So they make it a little more difficult than, purchasing term insurance. Term insurance, by the way, only 2% of those policies ever pay out. They're incredibly profitable for insurance companies. That's why you hear about term insurance.
Yep.
So buying a life insurance policy like the one I'm talking about, which a cash value policy, this is kind of how it works. So I liken it to building a 5-story building where you have to pay the mortgage on it immediately, but you only are allowed to collect revenue for the first year. Collect revenue on the first floor the first year. The second year, the first floor and the second floor. The third year, the first floor, second floor, and third floor, that's where you start breaking even. And then the fourth year, fifth year on, you can collect revenue from that whole building. That's how the cash value accumulates. So how does it accumulate? Well, the insurance company puts it into 95% of it into a general fund that invests in municipal bonds, what's considered extremely conservative, safe investments. With the other 5%, they buy call options on indices, and they take that profit that they make from those options and recredit it back to you. So that's how you see that this is actually a good investment. And what makes this even better is that you're stopped out at zero. You'll never earn below zero. So if the market goes down one year, right? So let's just talk about this, right? Let's say you have $100,000 in the market and the market goes down 30%, right? You need to make 43% to get back to your original place, right?
Yeah.
With this advantage of investing in these life insurance products, you'll never go below zero. So you don't have to make up that amount. That's how you suppress volatility, and you're taking advantage of the upside. So That's how your money grows. You never have to make up a loss, and you're just taking advantage of the upside each year.
What's the average return in something like that?
When we put together a proposal for a client, we're assuming a 6% rate of return on average. It comes in more around 7 to 8%.
But be conservative, right, with the expectation.
Right. And now when you're looking at what the market's done, if you had your money in the market over the last 20 years, you've earned an average of 5.9% because of those downturns as well, right? That's before management fees, that's before taxes, right? Inflation. So what you've really earned is closer to zero.
Right.
You don't have that issue with life insurance because you've already paid the taxes on that.
That's a fantastic point, again, because when you look at your portfolio, a lot of times, are you factoring in the fact that inflation is 3 to 4%, right? Mm-hmm. So if you've earned 6%, really, now that puts you at 2%. And then let's say your money manager is a percent or 1.5%, right? You're down to 1%, maybe 1% that you've earned when you're looking at and taking those factors into consideration. Yep. So really looking at something that's going to outpace inflation and also really understanding the fees that are associated. And we talked about this earlier, Eric, that the transparency is critical because a lot of times it's intimidating to people that are investing and they don't understand what questions to ask. And so they don't know where to look for fees and that true return after fees and after inflation and all that great stuff. So you guys invest in the market, you invest in things that are conservative to help keep pace with inflation. Then you also take a portion into speculative investments like options to really outperform and make up that volatility difference, it sounds like.
Yeah. And again, it's purchasing call options. So if it goes against you, you've just lost nothing.
Lost the premium, right?
Right.
Yeah.
Right. Because
so you're good there.
Right,
Yep.
because the insurance company knows that 95% of your, let's say it's $95, they know that they can get to $100 just by, the investments they're making in the conservative stuff. So they're playing around with the extra 5%, and that's where you get your gains from.
Well, and it's a great strategy that a lot of people use to be able to generate additional income in their portfolios. And so call options are, fantastic for that.
Yep.
But it sounds like it's a great way that you guys are diversifying to really outpace the market and make sure that you're getting those returns that you need. So who would need to look at doing this? Who listening, get a mental checklist, like, do I have this, and this quality? I should look at getting a policy like this.
So if you have kids who are going to be going into 8th grade and 8th to 12th grade, this is a phenomenal vehicle to finance your kids' education. You don't have to take outside loans. You could take a loan from the insurance company against your cash value to pay for college.
And is that going to be taxed when they take that loan?
Nope.
Nope, it's not, guys. So think about that. One reason why, and I just to pause here for a second, is a lot of people look at like 529s or UTMAs or right where it's specific to an education and it has that contingency that it has to be used on education expenses, tuition, books. And what if your kid doesn't go to college? What if your kid's like, I want to have, join, a band or whatever, right? And so you need to have flexibility and versatility in how you use your funds. Another thing in some accounts, like an UTMA, for example, that money legally belongs to the minor, and regardless, it's going to be theirs. And so, like when they're 21, or it depends on the state, but this gives you flexibility as the adult and the parent to be able to see and gauge, like, do we want to use it for tuition or for, a trip to Europe when they're, 18 or whatever the case may be.
Anything to pay for your kids' pay for your kids' wedding. You can use it. You can use it for anything.
A lot of people think that a 529 is the only, tax effective, account available for children. And that's just not the case. It's just the most talked about because it's a state sponsored, vehicle. Yep. So I think that's a great point with this. Great example. What else? So you got kids. That's a ticker on the list. What else?
Well, we mentioned long-term care before, and this is really for anybody who's going to need to tap into a pool of money at some point in the future. Let's say, you want to buy a house and you don't want to take on PMI, right? You need 20% down PMI. You can just take out a loan against your cash value and satisfy that 20% down, so you don't have to pay PMI. If you want to start a business, you can use that as collateral for cash to start your business. I mean, there's anything, imagine it, and that's what you can use this for.
Are there any restrictions on what you can use it for?
No. Well, nothing illegal, but yeah.
Right. Nothing illegal, guys. Okay. We're not promoting that, but any financial life cycle event that could happen to you, like you just gave some really great examples, you may have something really unique. And as we just talked about, there's no restrictions on what you can't use it for. And so I think that's a really important factor, when thinking about this. So what are some tips that you can give to individuals that maybe are looking to purchase insurance, or maybe they have an insurance provider, but they see that there's maybe some better opportunities like for switching, give us some thoughts on that.
So, one tip I'd like to give that's incredibly easy that people don't think about, and I'll get to the insurance in a second, is that if regarding your Social Security that you've built up throughout your life, you can take it as early as 62. The age where it's considered fully funded is 66. But if you wait until you're age 70, you get 8% growth per year on that money, right? So if you're, let's say at age 66, you're getting $2,400 a month for the rest of your life. If you just wait 4 more years, you can have $3,200 a month for the rest of your life.
Very big difference.
Makes a huge difference, right? So that's why when I speak to people, we talk about hybrid retirement. Like if you can put off that distribution of Social Security until you're 70 years old.
Yes, I love that. So there might be a small gap, right? So if Social Security is something you're going to factor in and it's going to be available to you, right? I mean, that's debatable depending on who you talk to. But let's just say it's available. So you might have a 4-year gap, depending on when you would take it, and you need to fill that gap with some cash, with some cash flow, and that's a great opportunity for insurance to fill that gap.
That's right. And another point about insurance is if you have a term policy or you're thinking about getting a term policy when you're healthy, make sure it's a convertible term policy, because although there's no cash value in that policy, you can grandfather in your health profile into a whole life policy when you first took it out, right? So if you're buying a whole life policy at 50, for example, and you bought a term policy at 25, you can grandfather that 25-year-old health profile in, and it's going to cost you a lot less to build that whole life policy.
I mean, we all want to be in the same health, at 50 than we were at 25.
I'm not.
But it's not going to happen.
Right.
So that is a huge takeaway, guys. If you're going to do term, because again, term does cost significantly less, but it's not building up a cash value. So if you're going to buy a term insurance policy because you don't want to not be insured at all, just because you can't necessarily afford, a policy that builds cash value, make sure it's convertible. And so that means that you would do the health screening and the physical, the blood draw and all that when you purchase the term policy.
That's right. Do that. That is one small thing that you can do if you're considering a term policy and and money's tight. I would recommend that.
How can someone figure out how much insurance they need?
So what we do is on our first meeting with a new prospect, we just get an idea of what they want their life to look like. Right? Don't imagine the best case scenario. What do you want your life to look like? And then we design a plan based on what they have now and where they want to be. And we kind of we kind of work backwards to the present, and then we calculate what exactly they need to do starting today that will make a huge difference in their life. And everybody's intimidated by this. Don't be intimidated by this. It's completely doable. It just requires a first step on their part to either speak to their financial advisor. I'm happy to speak to anybody. You're welcome to join our Thursday webinars and get a whole lot more information on how this works.
So where do you go to join the webinar if someone wants to, because I'll link it in the show notes so that way people can see your tan, right? If they're just listening right now, and they can ask you more questions.
Yeah.
Where would they find that?
So they can just go to my website at puresurance.com and just, fill out the form and say webinar, and I'll send them a webinar invite. They could send me an email to eric@puresurance.com. That's ERIC, and put webinar in the subject line. I'll let them register for it. I'll invite them to register for it there. And then of course the link that you're going to post, they can do so right through that link.
That's perfect. Okay. So if you're driving, doing the laundry, however you're listening to the podcast, I'll make sure to link it so that way you can just go click on it directly. Or maybe you have great, a photographic memory, or, maybe you'll remember it, but just in case, I'll link it for you guys. What is if people can just take away one piece of advice from this entire episode and only remember one thing, what do you want it to be, Eric?
Only contribute to your 401k up to your company match.
That's huge. That's a huge takeaway. And I think something that a lot of people need to consider and look at their current situation and how they're using that 401k.
That's right. It can make an absolutely huge difference in your future finances, not just in retirement, but as you grow through life and things that you might want, houses, cars, so on and so forth.
This was jam-packed full of some great nuggets of information. Guys, I will link everything for Eric and his company and his webinar, because again, to be able to grow your knowledge is, as much as you're willing to invest in your knowledge and your ability to understand finances, is really determines how successful you'll be. And so going and attending a webinar, for example, with Eric is a great way to put another tool in your tool belt. So then that way you can be able to meet your financial goals. So with that, thank you for tuning in today, guys. Eric, thank you so much for joining us. Maybe we'll have to have an encore and have you come back for a round 2.
It would be my pleasure, Courtney. Thank you for having me.
Thank you so much. Thank you, guys. And make sure that you're following us on Instagram, TikTok. It's at Financially Free Journey. I post daily tips and motivation to help you with your money goals. Until next time.